Tēnā koutou katoa to everybody. Welcome to the Investment Committee meeting today. Just to kick off with, I'd just like to quickly remind as a matter of procedure, everybody in the room and online, that this meeting is to be conducted in accordance with Council Standing Orders and as mandated by the Local Government Act of 2002. This includes all the rules for speaking, making motions, voting and addressing conflicts of interest, and it's mandatory for all members of the committee to follow these standing orders through the proceedings. So any questions, please raise your hand, just a formality. And now, would anybody like to open the meeting now with a karakia? Kaumatua, George, would you like to? Or I can do it myself.
Thank you, Mr. Chair, except for the kaumatua stuff. But anyway, hara tonu, kia ora tātou. He kororia ki te rongorawa, he mangorongo ki te whenua e whakaoro pai ki ngā tangata katoa. Nā reira pā tēnei anō pono turupuka nei ki a koe. Tā mātou ni nau noho mai ki a mātou. I roto I tēnei o tātou, he ngāka hau mō tā mātou huinga I tēnei rā. Nā reira pā anei mātou pono anō, ake tono ake, ame e mehi. Āmene.
Amen. Mate minui. Karakia. All right, so we'll move to agenda item 1, housekeeping. As you're probably all aware, this meeting is being recorded for later uploading to the Regional Council YouTube channel. I don't think we have to go over health and safety. We don't have any external members, so you're all aware of health and safety issues. Apologies, as you've probably all been made aware, Rick Stolberg is an apology, so if that could be noted for the minutes for today. I don't believe there are any other. Oh, yes.
I'll move.
Oh, are there any other apologies? I don't think so. No, none to note. All right. May I have a mover? And seconded. Thank you. Right. Just need to be 101% sure we've covered everything. All right, conflicts of interest. So moving now to conflicts of interest. Does anybody here today feel they have a conflict of interest they wish to note for the proceedings for any of the agenda items? Looking around the room, looking online, no one's raising their hand. Okay, so please, if you notice one arise during the meeting, please signal that actively through as we go. All right. So moving on to agenda item 4.1, confirmation of the minutes of our last meetings. Any comments before I ask for a mover? Any objections or additions, edits? Nothing to note? All right, could I please have perhaps a mover to accept those minutes? I think they are fairly simple. Jeff. Seconder, please. Yes. All in favour, say aye.
Aye.
Okay, so those minutes have been approved. Motion is carried. All right, we now have an action sheet that we need to go through. Shall we go through that action sheet, Bruce, before we?
So, Chair, there's one item on it that's in relation to the next agenda item on the sideboard, so I think we can move ahead unless there's any questions.
Any questions before we proceed? No? Okay. All right. So can I please have a mover for that action sheet?
I can move it.
Oh. Yeah. I second. John and Jack. Thank you very much. The motion. Oh, all those in favour, say aye. Aye. All right. Thank you. All right. Moving ahead. The motion is carried. So this, I guess, means we're moving straight into item 6.1, which is the which is the SIPO. This has been rewritten, thanks to Scott. There's been a few comments offline in between and a couple of discussions, which I think we'll take into account now, but I think the best way to proceed is perhaps to pass the talking stick to Scott, who can intro, unless Bruce has an objection.
Can I just make a very brief opening comment?
Of course,
Chair,
absolutely.
And Scott then. So just want to remind the committee that this is part of the follow-up work from when we had some discussion with council about the potential for a CCO, and there wasn't the appetite at that stage for a CCO. It's on hard status quo, and so the purpose of rewriting our SIPO is to ensure that we can meet our objectives under the terms of reference for the investment committee, and that is to identify opportunities that will maximise the value of the portfolio and the returns. So that's one of the key things. That's in terms of reference for the committee. And the work we've been doing on the SIPO with Scott is looking to actually give effect to that, and through a different approach to the way that we manage the funds under our SIPO. And it's a more flexible, nimble, agile approach. And I think it provides us much greater scope and opportunity to look to maximise the returns for our investments. But at that point, I'll just hand over to Scott.
Yeah, thank you, Bruce. Thank you, Daniel. So, good afternoon, everybody. You'll have the paper in front of you, and yes, it is a rewrite of the SIPO. Effectively, the former SIPO was probably written more from an advisor perspective, but has two components: the short and the long-term fund. What we've tried to do here is actually bring into recognition the fact that you have an investment committee, and that investment committee has some expertise in it, and we want to try and utilise those expertise as best we can in terms of the management of the SIPO. The SIPO itself is a policy of council, so it's council's set of rules by which the managed funds are managed. And so, this is the top tier of how you manage your investment portfolio, and then you're looking to disseminate that down to the investment committee, to the investment managers, etc., to then go and act and make sure they act in accordance with that. In terms of, is it easiest to do is that this is a kind of a page turn?
Yep.
In terms of the paper, and then take questions. Is that going to be the easiest way? So I think in terms of the way that it's been drafted up, if you look at the roles and responsibilities, we had a discussion as a little workshop probably a month ago to look at the role of the investment committee and the role of the council in relation to the SIPO. So the SIPO is basically, it is a document of council. It is signed off by the council. The investment committee are the ones that have the relationship out with the investment managers in terms of that investment manager selection. And so it's very much governed and documented around that. The other piece that's quite noticeable is that the SIPO is looking to separate the policy component, which is the SIPO itself, from the operations component. Yeah. And that basically allows the investment committee to manage the operations component with the investment managers that are chosen as part of that process. Responsible investment, I know, is one where there has been some discussion through emails earlier. Where the SIPO is looking at is twofold. One is there is a set of principles under which investments are made, that of responsible investment principles. And then secondly, after that, there are a set of exclusions that are provided. You currently have a process whereby your exclusions are effectively the first part and your principles are the second part. And the other thing is too, that with your exclusions, you've got quite a long date in terms of trying to get some of those exclusions to actually be effective. One of the comments that sits inside here is that it recognises that 100% exclusion of anything is actually very, very hard. So what it proposes is that at each company level, there is a 10% revenue threshold. So in other words, if a company is 90% doing things into assets that we think are fine, then as a revenue basis, then that means that it's not effectively running that exclusion as a majority of its business. And so that should mean that actually the investment into excluded assets is very, very small, because you've got, most assets won't have those exclusions as part of their asset portfolio. And then there is a very small slice of some that are effectively are eliminated because they, so a company, for example, like Philip Morris that produces tobacco, will earn more than 10% of its income from tobacco, and so therefore it will still be excluded. But it just gives you that threshold so that you can make sure that you don't end up in a very, very narrow universe, because a slice of a slice of a slice of a slice is there. There are a number of exclusions on there, which I guess there possibly will be some discussion around whether they remain exclusions inside the portfolio today. The wider the exclusion set, the harder it is to manage the portfolio from an investment perspective, because a lot of the products that are out there on the market have a standard set of exclusions. And if you have a different set of exclusions, then you end up with a bespoke offering. And that's the decision of council, though, in terms of, or this recommendation of this committee up to council in terms of that. Do you want me to break there and have a discussion at this stage, Bruce, or do you want me to carry on? Sorry, Daniel, in terms of...
I think you should complete all the main points you want to make, and then we can open it up to general discussion.
Resilience. So resilience is kind of tied into the portfolio, and it's part of the asset allocation that we have there. Resilience is part of your short-term fund at the moment, and basically the proposal is that that continues to be invested, but we separate out the treasury component of what Simon and his team look after over there, so that that is separated and outside of the fund, and largely that's in cash today anyway. And then we get into the asset allocation, and the asset allocation here, what we've done is we've derived that asset allocation based on the fact that it's effectively investment of council's reserves, whether they are council reserves or ratepayer reserves. I mean, that's what your managed funds portfolio is. And we've looked at the likelihood of that through the long-term plan in terms of whether it's growing or it's declining as a spend of that capital. And we've also looked at whether that is called on in a planned basis, or, you know, like a disaster is kind of called on very, very quickly. And that then helps you in terms of how much liquidity you need to actually have inside that portfolio. And so the recommendation that's been made there is that you go to a single asset allocation of 70% growth, 30% defensive assets, which is not too dissimilar from where you are today. And that should allow you to generate the levels of returns that you're forecasting to get in your long-term plan. The other piece is around the asset classes and asset limits. So again, in your SIPO, you specify which asset classes are permissible. It is up to your investment committee when they negotiate with your investment manager as to where the limits on those asset classes sit, but they have to sit under the overarching umbrella that the SIPO provides. And the only other one that's in there is a liquidity limit, because ultimately these are reserve funds and we need to make sure there is a form of liquidity there in case they are called on for certain points. And the only one that that really affects is private equity, because most bonds, equities, etc., are able to be sold within a reasonable time frame. Private equity is a little bit more illiquid, as you know. And so we've kind of put a cap on that in terms of an individual level. I'll stop there in terms of the paper, because I think the paper was trying to define the difference between the old SIPO and the potential for the new SIPO. And happy to take comments and questions.
So before I forget, just to pick up on the last point you made there, Scott, a cap on the private equity exposure. Can you, point that out to us?
So it's in the paper on page 16, and it's also in the SIPO under liquidity needs. Sorry, they're inconsistent. It should be 30% there. So under liquidity needs, and it's on page top of 24, fund shall have no more than 30% exposed to unlisted assets.
Okay, so that's broader than private equity. That could include other unlisted assets. Okay,
yes,
that's fine. Looking around the room, I think maybe it would help if we go one by one, just to be orderly about it. Unless somebody has burning questions.
No, I don't have any burning questions at all.
Okay.
But I'd just like to ask your advice and George's advice, that's all.
The hedging, our current hedging. What sort of hedging do we do? Nothing?
Nothing.
Because I haven't seen anything. That's why I just wonder why it's in there.
We don't actively hedge. We leave it up to the managers, fund managers.
Okay.
That's my understanding too. Is there a concern?
No. I hadn't seen any report on a hedging. just wondered,
Okay, we've got Scott.
obviously our fund managers do it in a certain way within US dollars, I suppose.
Yeah, so if I can just add a broad comment from the market on that, what tends to happen is that any income assets that you have, so like bonds, if they're in overseas bonds, because what you're chasing there is an interest rate, you tend to have those 100% currency hedged. In terms of growth assets, it then very much is it's a manager preference, but it should also be, and this is why you want to try and leave some of the discretion around the committee. It can be either anything from 0 to 100% hedge, depending on where they sit. Most sit between 0 and 50. For entities like this council, where you've got quite a high concentration of exposure to New Zealand dollars and a high concentration of exposure to a region, then quite often you might have a lot of your offshore assets unhedged for benefit of that currency exposure effectively. So that's why you leave it open, because ultimately different managers have different views, but you also they need to consider what are the other assets of council and the exposure that council may have.
Okay, so to summarise, the bonds are almost always going to be fully hedged, and the others are open to advice, open to debate.
Yes.
I think in my experience, the most common hedging ratio for non-bond assets is 50%. You could argue it up higher than that based on the fact that our liabilities are New Zealand dollar denominated. So why would you bother to take foreign currency risk unless you saw some natural benefit in that, in reducing risk or improving returns? But I think that's detail we can get to later, because this doesn't actually tie us in a straitjacket in that regard. That can be treated
It's just
as an implementation matter.
Yeah, just because, hedging is a risky opportunity in a council situation because we're so slow that the hedge has probably already been and gone. And so obviously if it wasn't done at our investment advisor level, do we have to give them the rights to do that, or he just takes it as his role?
My own view is that we should own that decision, and or at least we should ask for advice from the underlying managers and then rubber stamp it or not. We shouldn't just say, "Oh, you do that," which is what we do now. So at the moment, I can't tell from the Ericsson's report whether we are or are not hedged, or whether we're partially hedged, or and what is the hedging ratio? Is it 35? Is it 82? It's impossible to know, and I think that's a blind spot for us. And
because our return will be up or down.
Yeah, we don't know. We don't.
Dollar exchange.
Yeah, all we know is the return he gives us, but we don't know what part of that is attributable to currency movements.
So I think our private equity in American terms is quite significant, isn't it?
Yeah, and I'd be willing to bet that's unhedged. But then there's all the liquid stuff too, and it's opaque. And because if you make a 10% return on a share overseas, that could be wiped out because the currency goes against you by 10%. So it's what I'm saying is it's significant.
So there's a little bit in the report missing from Ericsson's. Is that what this is hedged at a certain dollar rate?
I just think it's of such strategic importance that it was a mistake to delegate. Sorry to be so blunt, but I think it's a mistake to just delegate that and then look the other way and not have any idea.
Because we could have bought
governance.
A lot of private equity at 67 cents or 65 cents American, right?
And that's the problem when you're unhedged, because then what matters is what are you going to get that back for, and what was the currency movement in between times? Do we know what that is? Yes or no? And at the moment, I'd be willing to bet no. The answer is no. We have no idea.
Okay.
So we may have lost. We may have gained on the underlying return.
Value of the equity.
No idea whether we're losing on the currency or not.
Yeah. So so our equity valuation could be up and down on the.
Yeah, but it doesn't matter if the currency went against you. Right?
Oh, that's right.
Scott's got his hand up. I think George has too.
Oh.
Thanks, Jack. No problem. I was rather more interested in the discussion that you've just conducted. My question should come probably at the end of any further discussion about that, Chair.
So I think just to add, if I can, Daniel, sorry, just to add to your comment, yes, if you take this as a natural process, you create your SIPO, you then go out and you potentially do an RFP to look at the different managers that might be out there. Each of them would come back and propose how they would handle hedging. And that's really your opportunity as a committee to determine where is the levels of exposure that you are happy to sit at. And then ultimately it's the manager who will go away and make sure that that hedging sits inside the portfolio at the right levels. So it is a but yeah, you're missing one of those gates, I think, early on in the existing SIPO as it stands today.
My recommendation for what it's worth to the committee would be that we do be explicit about this and have our own strategy around currency hedging. And I think one very easy thing to say straight away without much debate is the bonds are going to be hedged, right? They always are anyway. It'd be very strange to go to a manager and go unhedge those bonds, because they'd say, well, no one does that. They're already hedged. All you're doing is creating a whole lot of volatility and it'll swamp your return on your bonds. The part so that's one I think we can just write in straight away, unless anyone around here has some violent objections to that piece. The other part that's more debatable is the risky part, anything that looks like a share or an equity. And there I think it has to be somewhere between 50 and 100. And we can either say now, well, we prefer it to be 50 or we prefer it to be 100 by default, or we can say, actually, we'll leave a placeholder for that and see what comes back in these RFPs, or if we get it, or we can get advice on it if we want. For what it's worth, again, my view is unless we see some wonderful value in having foreign currency exposure, which has volatility, then we should by default be fully hedged. But I'm happy to argue that point with anyone who cares.
Well, you're sitting in that seat for a reason. Good advice.
Yeah, you're earning your money today. I'd like to listen to advice. It sounds good to me, but I mean, I'm no expert on hedging. George, Scott?
It's a
Not
single
first on the
sentence.
hedging.
Yeah.
My view is that all SIPOs are a form of hedging anyway. Just not that perverse form that you bet against the collapse. Sorry, Scott.
Yeah, look, I've come from an unhedged background, depending on the nature of what you're trying to do. So, and the reason it's in there from 0 to 100 is you'd never overhedge an asset, because then you're taking a currency, you're speculating effectively. But it depends on what you're trying to hedge against. So in my previous role, where I had a very large exposure to New Zealand assets and I had a large exposure to a port and the Port of Tauranga, the equity portfolio that I held was unhedged for the benefit of the exposure that we got at the portfolio as a whole. Because if New Zealand got hit by foot and mouth or something like that, and so therefore I lost my export through my port or something similar, then our dollar would fall and I would get the benefit of a currency exposure at the other side. I mean, again, it's, and this is why I say every organization's different. I think you want to look at it in the portfolio sense of where is in Northern Regional Council's portfolio and all of those other things, and how certain is some of that income, and what are you trying to draw on? I'm not coming in here with a clear view of some people who hedge infrastructure assets, for example, because they are almost like a bond. You're trying to get a yield out of them. Others, they may not hedge to the same degree.
I can remember the days of Rotonomics, and my neighbour borrowed money offshore because he could get the interest rate at a quarter what the New Zealand rate was, but he borrowed offshore. Then there was a currency change over the next 3 to 5 years, and all those farmers went out the gate because they couldn't meet that extra capital cost. But and Beef and Lamb does the same thing. I think, as Scott, you mentioned, they invest offshore for if we did get foot and mouth, relying on our dollar crashing, bringing money back to help out in the first few weeks. But my question was about that 10% exclusion. Is that the right figure? Because I mean, some would say it should be, could be more, could be less. If it went to 20%, you would get a higher return, or is it marginal? I just wondered how you got to the 10%.
This is in terms of the excluded assets.
Yeah. Tobacco and those things.
It's just 10% seems to be a reason. Seems to be an industry convention in terms of that. And what they're trying to do is they're recognizing that it's really, really difficult to get an absolute zero on some of these things, because some company might have a small offshoot in something which is not permissible.
I get that, but if you jumped it to 20% and say you got an extra 2% return on your assets, you think, well, maybe we should do that. Morally, it might be the wrong direction, but that's what I'm asking.
Yep.
If you jumped it to 20, would it make any difference?
Look, I don't think it would make a lot of difference. I don't think by having a small amount of exclusions that you necessarily change the universe that much. If you go to an absolute exclusion, then I think you do change the investable universe quite a lot. And I think that's where it starts to get risky. And the more things that you have in your exclusion list, the more potentially you make yourself different and more bespoke from what the rest of the market actually has. So, the more bespoke you are, the more it costs you to try and get a manager to service what you're trying to do. So, I mean, I would stick at 10% because market convention is there, and most of the managers that you would potentially invest through would probably have a threshold that's at that same level.
Thank you.
Follow-up question, please, Mr. Chair. For you, Scott, is that 10%? Are they stated anywhere in the ESG standards? Those exclusion levels?
No, they're not. Partly because a lot of the ESG standards, I think, George, they're probably more about principles of investment. And so they're more about the principles piece, which is the piece you got up the top. The exclusions piece tends to come at that next level down. Okay. And so, I mean, if you looked at the super fund, they're probably at a 10% level. If you look at a lot of the funds, when they do their tests, they're probably at that 10% level as well.
Then I'd like to go back to my other question, if we're finished on hedging, and that's around the table you've got on page 15, and thinking about the proposal, which is to change is to combine the short-term and the long-term funds into the fund. But I assume that you're also going to be recommending that there'll be a percentage of reasonably liquid assets in that 12-month range.
Yes, there are. So again, if you look at the asset allocation target, it says that you've got 70% growth and 30% defensive. So within that 30% defensive, while we haven't expressly said it within the SIPO that it must be 5% cash or 2% cash or whatever it happens to be, that's where, again, trying to separate the policy piece from the operational implementation. My expectation is that investment managers, if you ran an RFP, would come in and pitch and say, this is how we would make your 70-30 ratio up. And the 30% would include 15% global bonds and 10% New Zealand bonds and 5% cash or whatever it happens to be, and so that will have that cash flow component in it. The other thing is too that within each of these, you will expect there to be trading within each of the different portfolios, which puts cash back into it anyway. And that's where the 30% in terms of illiquid assets as a cap is very, very important, because again, these are council reserves that may get bought up. The other piece that's probably I haven't really discussed, but it relies a little bit on the other gentleman in the room there in terms of Simon and his role. The long-term plan forecasts out how you're going to plan on spending your reserves. And so that is effectively the spending of reserves is, you've got to think of it in the portfolio sense as a drawdown of capital, right? As we're taking some of the capital out of the portfolio because we're spending the reserve. Through the long-term plan, the cycle of that spend. And so every year I would expect Simon and his team to be able to come back and say, next year, our forecast is that we're going to be spending $3 million of capital. That will change the weighting very, very slightly in terms of how the portfolio needs to look.
Thank you.
Sorry, can I just raise a point in regard to all of that? There's the short-term fund, long-term fund, and liquidity and cash and all that jazz. If I've understood my reading of this pack correctly, effectively the short-term fund won't exist anymore, but meeting short-term treasury needs is actually not going to be an investment thing anymore. It's going to be a treasury thing.
Correct.
and that's going to be handled by finance. So we
Yes.
don't really need to worry too much about that anymore. It's more a long-term investment. Is that correct?
That is true. The only piece that potentially we've got to be considerate of is the resilience aspect that might sit there. So if we underperform in a whole lot of other parts of the market, in other words, the port doesn't pay us out a dividend or whatever, then we may need to be utilising that resilience that we've got invested in here as a small portion, but it's a small portion of the fund that comes back.
Yep.
But the day-to-day operational treasury management is stripped out, and that sits with the finance team and Simon's capacity there.
I mean, in my view, that's exactly the right approach to take. That seems to me to be.
Well, Simon, you know, what you've made extra this year just by having that capability in the last financial year, you probably added what, 300,000 or 400,000?
300.
300 by just being flexible.
Cool.
It's going well.
Thanks, Daniel. I've got a couple of questions around the geopolitical risks. I have a great deal of worry about how things are going to be for the next 18 months to 2 years. I think after that, we'll be quite so bad. You know, like Ukraine's not going to get solved anytime soon. Gaza is likely to find Israel on the outer somewhat, so there'll be implications for armaments and so, which may not affect us. But it seems to me that Trump doesn't care whether he crashes the US economy or not, as long as he makes a few bob out of the process. But so I worry about us being tied to the states and financially and defence-wise, and I realise some of this is outside of any interest that we'd have in it. But I worry about geopolitical events influencing the market, and I also believe that New Zealand needs to be tying itself a great deal more in terms of overall safety to Europe, Britain and Europe, rather than being beholden straight to the States. So I think I raised this last time. I know I'm a bit of a pacifist and everything, and I'm not keen for us to invest in munitions, but if there was an opportunity to invest in expansion of British, French, Italian and German, Polish munitions, I'd be seriously looking at it right now, because I believe it's in New Zealand's interest to do so. And it's in this region's interest as well, because we're in an incredibly unstable world. And I think that over the next 1 to 5 years, the world will be looking to Europe to be the stabilising influence. So will that be reflected in the markets? What does that present for us in terms of opportunity? And will it have any implications for our SIPO? Because I notice we're quite sort of play around that point there. We say cluster munitions, nuclear stuff, anti-personnel mines and civilian automated weapons. That's not the whole field, is it? That's not bombers and planes and drones and whatnot. So some answers, please, from the experts.
I'll start on that one. We could talk all afternoon on this one. I think that the first point is, again, what are we considering here? We're considering the SIPO, which is the overarching principles that effectively council wants to adopt. When you get into selecting a manager and looking at how, you know, what is the exposure to global equities and where do they sit and how do they manage those risks and how do they manage those opportunities, you know, that's really a discussion that we have at the next level down, and this committee would have with each of the managers when you're working out who is the manager that might be, whether it's the incumbent or a new manager that takes you forward. You know, how do they take those opportunities? How do they tilt at different times to see those opportunities and have them come to light? So I think it's a secondary conversation that has to take place there. The one that is about today, to a degree, is around the principles that sit there around your responsible investment and your exclusions as to whether you believe that they should be in the SIPO or you believe they come out of the SIPO, to allow the flexibility in term, because that ultimately is council standard that the whole of council needs to adopt, and the committee will recommend up to council to consider. So I think two parts, the RFP or whatever the next step is, will allow you to work with a manager to make sure that they actually understand the opportunities that the market might present, and The other piece is actually it's council's set of exclusions that we need to determine in that SIPO, because that's ultimately council's rules.
Do you think that the current SIPO gives us a little bit of wriggle room, doesn't it, in terms of its description of munitions and whatnot?
The current SIPO does, or this one
Sorry.
here?
This new one, sorry, the new SIPO. It
Yep.
just says cluster munitions. Obviously, it's, you know, mines, nuclear, and civilian automatic weapons. It doesn't. That still leaves it pretty much the rest of the field wide open, doesn't it?
Yeah, look, I think again we've tried to utilise what others are seeing as common, as industry standards in terms of those objections. The more specific we get, the more we risk getting into a path of our own, which makes it more and more less cost effective.
All I'm saying is, you believe this gives us the flexibility to invest broadly, and just excluding though in possibly rearming Europe, while still leaving out these sort of the really kind of nasty things like these, anti-personnel mines.
So can I give a little bit of background on that as well, just
Sure.
as an industry practitioner? The things that are really commonly excluded and which we won't have any trouble implementing, because Scott's raising how hard it would be, the more specific and the more granular we get, the more things we do. We'll find that we get so tied up in knots, we just can't do anything. So that we know for a fact that most managers in New Zealand with global equity funds and so on typically exclude tobacco, nuclear armaments, and what we call controversial weapons, which are the anti-personnel mines, the cluster munitions, which all, and that's the reason why Scott has put those in here, because they're low-hanging fruit. We know it's tick, tick, tick. We know we can, most funds out there will exclude those anyway. So we'll be fine. That's why they're in there. I think if you do anything beyond that, that's when you start going, oh, okay, if you want to put alcohol in there and gambling, you're very quickly thinning down the number of providers that will actually do that for you. On a non-customized basis. And we're too small, to be frank, we're too small to be customized. If we go out to the market with 60 or 70 million and say, customize portfolio, everyone will go, no, too small, can't do it. It's not cost effective. And, we'd do it for you if you gave us 100 million, but we're not doing it for 60 million. So we just have to meet the market.
So you just leave it. Would you drop off gambling and alcohol? Would you?
I would say, I talked to Scott about this on the phone before. As to the very best of my knowledge, there is only one provider in the market that does all of those things, and that's Simplicity. So if we took this SIPO and ran with it and threw it out into the market and said, who can do this for us? Everyone would say no, except for Sam Stubbs at Simplicity. So basically, we're defeating the whole purpose of an RFP if we do that. The other thing I really want to emphasise today, again, as a practitioner, is responsible investment in ESG doesn't begin and end with exclusions. Just because you say, I don't invest in tobacco, I don't think the game ends there. There's a whole bunch of other things that your managers can do for you and should do for you if you want to be a responsible investor, and that includes advocacy. They're talking to CEOs and CFOs all the time of companies. They should be advocating on the behalf in line with UN Good Principles for Investment, UNPRI, but they should also be exercising our voting rights on our behalf, but also all the voting rights of all their other clients in line with a good responsible investment. And I would argue that that activity is far more important and far more impactful than just saying, oh, we don't have tobacco in there, right? Because that actually can bend companies into shape and make them change. Just because you sell Philip Morris doesn't mean to say Philip Morris is going to go out of business. All that's going to happen is somebody else out there is going to buy it at a cheaper price, and Philip Morris will keep loading up the market with cigarettes, and people are going to die of cancer. So
we're not in the same position as the average investor, are we? We represent a community, and they expect us to lead with matters of principle. So
but they
find
won't
it
be
really hard to leave gambling in there. I think I could be bent on, because we don't have much investment in gambling in Northland, but if someone came to us and said, I've got a really great idea to turn all our waste kiwi fruit into a very high value liqueur or avocados or whatever, what are we going to do then?
Yeah. There's the market, the fund management market out there can be customized, but you have to be big. And in the scheme of things, we're a small investor. And I know that sounds disappointing. But it's just the way it is. The super fund can do all of this, right? They're huge. They've got nearly 100, I think it's touching 100 billion now. So of course, when they go to a manager and say, make this absolutely, of course they go, oh yes, yes sir, no sir. They won't do it for 60 million.
Well, some advice, guys. What do you think? I think Daniel's suggesting we drop gambling and alcohol.
Can I just ask a couple of questions?
Sorry, John, I know you had your hand.
No, fine. No, it's all good. It's related to the same matter. Can I just ask, we're setting a target, or we're setting a level of 10% here. How much do we currently have as our investment revenues and exclusions?
I don't think it's being managed that way, but I'll lean on Scott for that.
Yeah, so look, you've actually got a presentation afterwards from your provider, and that highlights that in some cases you've actually got excluded assets sitting inside some of your diversified managers at over 5% today. So 5% of the assets are excluded, but you're still carrying them. So in this one here, what you're looking at is you're looking at individual stocks and saying if 10% of that individual stock is effectively earning its income from one of our excluded camps, then they're not considered part of our investable universe. So I think this is actually a tighter threshold than what you have today. It's a little bit hard to tell because your threshold today talks about having to get there by 2027, and it doesn't look like you've got very far yet. So it's a little bit of you're comparing apples and oranges, unfortunately, Jono, in terms of that.
And Scott, the last sentence that we've got there, where an investment is recognised to be excluded, council expects the investment to be exited in a timely and cost-effective manner. What does that actually mean, given the conversation that you guys have just been having around how that's not possible?
I think it's still worth having that in there because it may, the investment, let's just say we are in our new world. Imagine we have hired a new manager and they're doing everything. A stock might creep into the portfolio because someone traded it almost by accident. It shouldn't happen, but you never know, it might. Or some company might change its behaviour. So there might be a supermarket provider, I'm just cooking up an example here, a listed supermarket chain that wasn't selling tobacco, and then suddenly overnight it decides, oh, we're selling cigarettes now. And someone has to pick that up at some point and go, oh, hang on, how much revenue is in there? Probably won't be more than 10%. But if it suddenly were, they would have to apply the exclusion screen and get rid of it. So I think that's worth having in there just for the avoidance of any doubt.
I wonder, last question, two questions. One is 10% too high, given that we're a public entity investing public monies. And I understand that if you're a more commercial entity and you're doing it purely on returns, then yep, 10% might be good. But one question is, that's why I was trying to understand what's our current investment return. How close to 10% are we? My other question is, are all of the things that are in this category the same? As in, Daniel, you said before that most of the ones on that first bullet point wouldn't be part of, whether it's a Milford's portfolio or whoever it might well be. You can't, they won't, nuclear weapons won't be part of that, whether there is actually an exclusion, the exclusion of zero. And then some of these other ones that are legal, but
I think this is a bit of a chicken and egg conversation. And I think we have to put a number in there, X, right? And we're just choosing X to be 10 at the moment. I think what we're going to have to do is when we go to market is consult with the manager and say, what are you actually doing? Is it 10 or is it 8 or is it 12? And then I'm sorry, we just have to do whatever they're actually doing.
One thing for you fellow councillors to think about is there's 3 of you here at the moment, but I suspect this might be a point for the rest of your councillors when it actually goes to council approval, and this may be the issue that some of them will die in a ditch on, and you don't get the policy all across the line.
When that I won't be there when that conversation takes place, but if you could please communicate to them everything I just said about what we can and cannot do. There's actually a limit to how much we can bend the market to shape. If we went and said the magic number's 11, no one will be doing 11, right? So we have to an extent, we have to get what we're given and take the meal that's served up to us. We just have to say whether we accept the meal or not.
Go zero for bullet point one.
No one will do zero is impossible.
But bullet point one.
Oh,
That's your nuclear weapons, cluster munitions, anti-personnel mines.
But there might be an opportunity to invest in a company that has a small holding of that stuff, very small holding. They might have 1% of that, but then 99% of their other holdings, an amazing investment opportunity that we want to get into. And if we exclude that altogether, that prevents us from that. I think that was Jack's point earlier.
I think you're getting, caught up here because the other side is, do we get a better return on our investments? So our rates can actually be lower. I mean, that argument we haven't really talked about, but that's the balance that we've got today. And I think there'd be a lot of people I know would rather,
Yeah, but also some of these exclusions aren't only ethical risks.
Just like what Bruce said, it's irrelevant
investment
and they
risks.
could trade it out.
I reckon
again
some of
with
these things will get
something else.
too volatile to invest in anyway. So I think being a little conservative is actually a good idea. But anyway, I think as regards to 10%, I think Bruce's response to Amy's email before kind of encompasses it all. There's 10% for each individual investment. So the total, what do you say, about 1.7? It's about the total exposure, was it? There you go. I haven't our total ESG exposure. Ericsson's report's about 1.8, I think.
It's pretty low.
Yeah, so I don't think we need to worry about it in that regard. I think 10% for each investment, each investment you make is fine. Yeah.
Like, that's a ceiling, right?
Yeah.
So, like we've got a lot of room to move. We're not even hardly registering at the moment.
Yeah.
So it would have to be something big. But I definitely agree with Bruce's response. They could be in, but they could trade that share out without us even knowing about it. By the time we get to think about it, by the time it gets to council, like shit, we've missed the boat. We shouldn't even be concerned about this stuff.
you could be investing in a company that supplies nuts and bolts, and that's all they do. But some of those nuts and bolts get sent to an arms manufacturer that puts rivets into bombshells. Is that ethical or not? You get tied up in knots if you dig into this too much.
Look, we have a defence force in New Zealand, right?
They get red.
We expect a certain level of defence. Look, I don't want to get carried away with this, but we've got a pretty good, SIPO outlining the 10%.
I think for this residual, there'll always be residual exposure or secondary or tertiary exposure to all of these things that we'd rather not have. It's practically impossible to remove that residual exposure. That's why the other piece of it is so important. That's the advocacy and the voting.
If it was 10% of our portfolio, we would have a problem. It's 10%
and it never will be. At an asset level, it won't be because the revenue threshold gets watered down.
Yeah.
So that's
okay. We can move on.
Look, I think I can get this over through council very easily. What we've just explained, and we're only trading at 1.78% at this moment.
If we ever got challenged in public about it, there are a lot of things that we can say that would appease people who are exercised about it. We could say, look, we've done all the standard exclusions that are market standard tobacco, nukes, controversial weapons, tick, tick, tick. Our managers are UNPRI signatories, tick. And hopefully we're going to choose someone that has a nice active voting policy and an advocacy policy. And we can say, look, they can't fix everything, but they're advocating.
And our exposure is falling because we're actively working on it.
I think the world's voting on it, but you can be extra sure you are and I want us to personally, I want us to hire a manager that put their hand on their heart and say, we have a policy that goes beyond the exclusions and actually does the advocacy to make the world a better place. And that's a big tick in my point of view.
Might get you to come to the council meeting, Daniel.
I'd be happy. I'd be happy to help you.
That's reality.
Scott's
I'd just add to that look, 95 to 98% of the world's stocks don't invest into this stuff anyway. They probably come through at zero. So you're talking about 10% of 5%. You're into the really, really small end of market where you're trying to find stuff. And a lot of these stocks that are there, outside of maybe a Honeywell or a BAT or Philip Morris, most of the stuff you're not even going to see because it's you're going to be investing into large index stocks anyway. So it'd be very, very rare that you'll actually end up in a scenario where you're tripping over yourself.
Yep. So I can't help one more piece of context, just because I think we are talking in a bit of a vacuum here in terms of 10%. Is 10% the right number? Right in front of me now, I've got the screening policy of Simplicity's underlying manager for their global bond fund. It's just an example. All of the exclusion percentages are somewhere between 5 and 10%. And they're the most aggressive screener in the market.
Yep.
So 10% of confidence them and anyone who might be not as aggressive as they. I think 10% is about the right number as a whole placeholder. But I think at the stroke of, if we have to accommodate a different number because the person, the manager we want to hire has a different number, we just have to pick up the pen and accommodate that in our policy.
Are we fretting too much about something that's not really an issue?
I think we ought to move on unless anybody has any burning
It's
thoughts.
about optics, especially in the public body, Daniel. We need it. But I accept everyone's explanations. That all sounds pretty good.
Yep.
Thank you.
Bruce.
I just want to make a comment on a couple of things. So we've also updated the Treasury Risk Management Policy, which is attached to track changes. I don't want to get into the detail of that other than to say it reflects the necessity of the changes in the proposed SIPO to make that policy work. And the other thing I want to point out under the terms of reference for this committee, we've updated that as well. And I think the most important thing within that update, the only material thing within that is clause 4.2, where we said to appoint and monitor investment and fund managers in accordance with the SIPO. So that'll be the responsibility of this committee.
Yep.
Which is, in fact, you've got some delegation to get on and do that part, which the committee should have anyway.
Yep.
So it's a change from current structure. Just wanted to make sure you're all clear on that.
So I see the lines through here. So we recommend, not the council,
You're recommending these. For that there, you would actually make
to appoint and monitor,
You've actually got the delegation now.
to appoint.
You'd have the
Rather
delegation.
than it actually
Okay.
going back to council.
Good. Happy with that?
Yeah. Okay, so we're still on agenda item 6.1 for the moment, and the only recommendation in the agenda for today is just that we note that the report is received.
Actually, I didn't
Oh,
realise
and
there's
so-
all 5 of them.
Yeah, there's 5 recommendations and
Okay. Sorry, my run sheet doesn't cover all. Apologies, I'm relying too heavily on it. So the report we received, the SIPO recommended for approval. Now, I just want to interject here. Sorry, I'm just waving my chair stick. I don't actually think this SIPO is ready to be approved because we've debated some things today. I think it needs another go over. I don't think we can approve it today. That's my view. Not least because there's a couple of spelling mistakes in it. So I don't think we can sign it off today. But I think that exclusion list
I think, sorry, to Chair, I think it would be good if we could note what reactions are needed to be completed. And if we could complete those.
and pre-approve.
Relate it to members, because we need to get on with the process of going to the market for a new fund manager, and the next committee is some time away.
Eminently
You can approve it subject to.
subject to a circular resolution of a final copy to be circulated and then a circular motion on approving it. I'm happy to work with you and John offline to massage it into a approval ready shape.
You send us a marked up copy, will you?
Yeah, we'll send you a marked up copy and via email.
Make it easy.
Yes.
so is there any of these 5 that we can approve?
Yes. Shall we go through them one by one? And if there are violent objections, people can note.
You need a mover and second.
Receive it.
Okay. So in this case, so the report be received. I think that's an easy one.
Yeah.
Well, I'll move.
Okay.
2. Yeah.
Second, John.
Okay.
Yeah, we're in favour.
One. All in favour, say aye.
Aye.
Can I modify number 2? The 2025 SIPO drafted recommended to council subject to further amendments following discussion today and subject to approval by circular resolution
Via email.
via email
Email circulation to committee members.
This week.
shortly.
There has to be a certain day we've got to work backwards.
What would be practical for you, Scott and Bruce?
Look, I can do something this week. That's easy. I just need a quick conversation with yourself as to where the tweaks need to take place.
By
Yeah,
Friday.
I mean,
Friday.
By Friday.
okay, Friday close of business, shall we say? Okay.
Yep.
Great.
Is that clear, Margaret? Have you got that?
Yeah, but I've
Yeah.
got it on the sounds.
Okay, right.
We're gonna work with Daniel on the changes.
And then, so we will respond by email by Monday.
Yep.
Happy with that?
Yeah.
So you got a weekend to read it.
Don't worry.
And do we need to
all
amend
weekends.
3, 4, and 5?
And boring.
We can
Let's go. Treasury risk management policy
in a week.
is updated. We haven't discussed that in detail today. Can we take it as read or do we need some discussion on that?
Which one? Sorry, item 3.
Treasury risk management policy.
Personally, I found it pretty vanilla.
Yes.
All right, okay, so
Mhm.
can I have a mover and a seconder for 3?
Jeff and John.
Who's that? Jeff and John. Yep, thank you.
Okay. Terms of references update. Now, again, we haven't discussed the tier.
I pointed out the only material change for on the terms of reference, Daniel, let's just say clause 4.2.
Okay.
Yeah, apart from that, it's just a few corrections.
All right, all right. Mover and a seconder for 4.
Sorry, that was Core and
And Crawford.
Thank you.
Core and Crawford. That's confusing.
We need to throw George in just to mix it up a bit.
Wake up, George.
I saw his hand waving.
Sorry.
Saw his hand waving.
And number 5 is works commence on a procurement of investment management services to be brought back to the investment committee. Well, that's obviously subject to the SIPO being finalised. We've only sort of discussed that implicitly today, but I think that was clear anyway from previous discussions. So okay, can I have a mover and a seconder for that one?
George and Jeff.
We're looking at George.
George
is. He's
Jeff and George.
Jeff and George.
Yep.
All in favour?
Aye.
Okay. So we're done. Wonderful.
So can I just go back? I'm sorry about this. So number 2, we didn't really move it or second it. I know you got subject to changes, but
Yes, right.
if we can move it or second it, it'd be great.
Oh, all right.
Subject to those
A
changes.
mover and a seconder for item 2.
Yeah.
Core, John.
George.
Yep, George. Thank you.
George. Yep. That one too. Okay.
You'll be actually moving up. I didn't hear any
All in
talk
favour?
around 3. Just,
Yes, we did.
Yeah.
3 was Jeff and John.
no, but did we have all those in favour? I didn't hear that. But
You're
anyway,
all in favour.
I'm pretty sure we all were.
Yep. All right. Great teamwork.
We go.
All right, recommendation.
All right. So unless I'm mistaken, we are now going to be moving to the public excluded part of the meeting.
I'll move it.
I'll second it. Happy.
All right.
All in favour?
Aye.
Aye.
You?
Yep.